Hi, welcome to today's webinar on investing and financial planning for Americans living abroad. My name's Tom Pewtress, Head of Global Partners here at Skybound Wealth Management, but also Head of our US Specialist Information Centre. We look forward to producing ultimately more of these webinars over the coming weeks, but today we'll be looking at investing and financial planning at a relatively high level and looking at some of the challenges that Americans living abroad have faced over the last decade or so. So without further ado, let me share the screen and the presentation that we have for you guys. And hopefully now that should be coming across on the screen. So, like I said, my name's Tom Pewtress. I'm based out of Dubai. I've been here for the last 8 years. I am ultimately far enough away from the US to help everybody, but not too far that I can't have conversations late afternoon and evenings with our offices and institutions and clients back in the US. A quick introduction to myself and Skybound. Like I said, I'm based out here, but I am also registered under our US entities. We have an operation over in the US. We have offices on the East Coast and the West Coast, and teams over there helping expats actually living in the US and doing the exact opposite, helping American expats living across the world. A lot of the advice that I will give to our clients often comes from the SEC registered entity that we have over in America, but I just have the pleasure of living here in the Middle East. Like I said, covering much of Europe, much of the Middle East and into Asia for clients living around the world. A little bit, I guess, about why I do the job that I do and specialising in working with Americans. First and foremost, I am British. Don't hold that one against me. But like I said, I have been working with US connected people for a number of years now, and I think it's been a challenging front when it comes to financial planning and investments for Americans living abroad for a number of reasons. But really it goes back to 2010. And in 2010, under the Obama administration, an initiative was launched called FATCA. And for most of you, you've probably seen this on documentation that you've filled out over the years. But FATCA was an initiative that basically asked all foreign financial institutions to report back to the IRS when they had an American connected person as a client. And it wasn't for the purposes of, withholding taxes or collecting taxes at source or anything like that. I think it was really around, making sure that Americans couldn't hide pots of money in the far corners of the earth. But post that initiative, you kind of had this big, huge world of financial institutions that just shrank overnight because additional reporting is additional compliance is additional costs, and additional cost eats into profits. And a lot of financial institutions around the world just turned around and said, well, we don't want to do that, so we're not going to do that. And the easiest way not to do that is just not have an American as a client. So this huge world of financial institutions around the world just shrank very quickly. And that could be simple as banks, through to financial planners, through to asset managers, anything. And it became very difficult from that point on. And I think a lot of people, having spoken to people over the last 8 years, what they would then just do is use US firms and put money back into the US and try and make it as easy as possible as they could on that front. And up until 2015, that was a relatively successful process, and is one that I would continue to implore people to explore today and encourage people to do today a lot of the time, if it's right for the client ultimately. But in 2015, the landscape started to change again, and we had a wave of regulation continued to be enforced, and for the safeguarding of clients and customers of financial institutions in the US, the SEC and other regulators continue to put pressure on financial institutions to make sure that they could carry out anti-money laundering and know your client checks. And for institutions that had clients living abroad, it's actually more difficult to do. It's more difficult to know and be confident in that KYC and AML than it is for somebody living in the US. And a lot of institutions, and HSBC were actually one of the first, ended up either firing their clients or restricting their brokerage accounts or financial accounts. And that just started to make life difficult, to be honest. So, you know, regulatory requirements are always changing. I think the other reason as well, many firms in the US stopped certainly giving advice to Americans living abroad, is also the complications of, if you're living in a different country, you have different rules to abide by. You know, for example, Europe, the sale of ETFs in Europe is something that's prohibited to retail investors potentially. And therefore, you may be breaking the law of one country by trying to abide by the law of another. And I think that's a difficult landscape to manage. And if you're not a cross-border financial planner that can understand both sides of the water, then you may end up running into some hot water for yourself and the client. So I think that's the reason why, again, from 2015, we've seen a lot of institutions back in the US shy away from Americans living abroad. You know, Fidelity, I know, is one, and is often a pain in my bum when I'm trying to work with clients. But I think if you have a brokerage account with Fidelity today and you let them know that you don't live in the US anymore, I think they basically write you a letter saying, thanks, but no thanks. Here's a check for your account. Goodbye. It's pretty brutal. It's pretty brutal. So, you know, my want to continue to expand and build a proposition for clients is one that means that, you know, you can do so freely with the choice that you should have as an individual when it comes to financial planning and making investments. So that's really why I do what I do, I guess, and we continue to expand our proposition. Skybound is a firm that has carried out financial planning services around the world for many years and has got offices from the US all the way across to the Middle East and Australia and everywhere in between. But, you know, from our point of view today, what we're going to be looking at is some high-level bits on financial planning. We're going to cover off budgeting, insurance, debt, and financial goals, and looking at the future and how to plan accordingly. So let's start with budgeting. Let's start with understanding income and expenses, and ultimately being able to budget for needs, wants, and savings. And I've covered this on the podcast that we have here at Skybound in the past, but you can follow some general rules of thumb. For example, when it comes to needs, wants, and savings, save 20% of your income, spend 50% in terms of what you need, and the remaining 30% can go on your wants. Warren Buffett always used to say, save first, spend after. That's another way of looking at it, and save as much as you can and live on the bare minimum. But from our point of view, it's kind of understanding that income and expenses. You know, a big part of financial planning is understanding your cash flow. If you can get a handle on your cash flow, you've got a good chance of success in the future. The issue that we've come across, though, no doubt, is potentially where to bank. And that's, again, driven by that FATCA initiative. You go through the paperwork to open a bank account, you tick that you're a US national, a load more paperwork comes out, can be a bit of a drain, and often some banks will just say no altogether because you are US connected. So I think from my point of view, it's very important to find a local bank solution where you can have your income paid to. Often if you're living abroad, you may be earning in a different currency to the US dollar, for example. You've got expenses in that local country, in that local currency. You need money to come in and out and deal with the day-to-day. And you also need to have in that bank account really probably 3 to 6 months of expenses in case of an emergency. And we call that something like a cash cushion. The reason for that is, you know, you may have unforeseen expenses, which comes up as, you know, the car may break down, the washing machine may break down, anything like that could happen. And therefore, you know, when you're looking at income and expenses, really important to think about building that cash cushion in that local currency and having it around and available should you need it. So once you've got that and you've got the ability to bank in your local currency, what I'd look at next is potentially either a bank in the US or a brokerage account that you can house potentially different currencies in, and moving some of that money back to the US. I mean, it may not be right for everybody, but the US does offer a significant amount of protection potentially compared to other jurisdictions when it comes to cash deposits. You know, we have seen bank failures this year again for the first time in quite some time, major bank failures in the US. It's not to say that other jurisdictions don't face those problems, but the US under FATCA rules offers up to £250,000 per person per account. Sorry, $250,000 per person per account. The UK, for an example, offers £80,000. The European banks often only offer up to €100,000. In the Middle East here, I'd be impressed if you found a bank that gave you any guarantee at all on cash deposits or insured deposits. So, you know, that's really important. So again, what I would be thinking about is looking at, you know, where you've got money, where it currently is today, what's its purpose, what's it doing for you. Once you've got that cash cushion, anything over and above that, looking at, you know, how you can allocate it to go to work for you. So banking is a huge part, and understanding that budget, that income and their expenses. I think once you've got a handle on income and expenses, you know, to go through your expenses maybe once a quarter, once every 6 months, at least once a year, go through what's going out of the bank account, make sure that you know, I did it the other day, we'd recently moved house, I'm going through my statements for the last quarter, gym membership. I've left that gym, I don't gym at that membership anymore. I've got the gym in my local community that I go to. I don't need that gym membership, so I can cancel that gym membership. I'm not paying however many dollars a month it is for that privilege. So again, just keeping on top of that stuff. Once you can keep on top of that stuff, it allows you to cash flow and manage your cash flow going forwards, and it gives you a better understanding of what you can actually commit to, what you can save to, what you can go and buy in the future in terms of wants, etc., etc. So once you've got a good handle on that, you set yourself up for the rest of the financial plan process. And it also starts to give you a really good idea of what your future expenses may look like, especially when it comes to goal setting. Let's look at insurance. Not a nice one sometimes, and actually probably the more morbid part of my job, but I'm going to start with the middle one here. So income protection, one that I think often goes missed by many people. And certainly single people who potentially aren't thinking about insuring, you know, their wealth or their income for loved ones, etc. at that point in time, because they may not have anybody of immediate family that they want to pass wealth on to. But income protection is a big one. I think the stats today are something like 1 in 2 people will get cancer. It's baffling. It's mind-blowing. And having immediate family that have suffered with cancer in recent years, truly devastating. Critical illnesses, you know, heart disease, strokes, anything like this. These are all things that can impact your earnings. These are all things that can put you out of work. These are all things that may have a knock-on effect to your career. These are all things that can impact your wealth, certainly in the short term. And for me, kind of that income protection is about transferring that risk of damaging my financial wealth because my health has been damaged, and transferring it to somebody else and getting them to pay me for a period of time whilst I'm maybe not in work or I'm earning less than I was as a result of having ill health. So having some sort of income protection policy or critical illness policy in place to safeguard me against that, or safeguard you against ill health and the damage that it could have on your financial wealth, is really, really critical. And that doesn't matter who you are, at what stage of your career, it's for everybody. Ultimately, it's managing, you know, the risk, the premium that you're paying for it versus the risk that's going to come down later down the line. It's not something that's going to hit everybody, but it's a large probability of hitting somebody, right, in terms of feeling that. So that is one thing I would definitely draw people's attention to. I would look at what coverage you've got in place at the moment. Potentially there's some stuff through work that will pay you, but often that's more geared towards medical rather than actually replacing a salary that's coming into the household. So think about that and have a review of the current protection policies that you've got in place, especially around loss of earnings, and the impact caused by ill health. Life insurance is always one that, again, it's a bit like income protection, especially if there's two of you in a household. You're both earning potentially, both got kids, putting food on the table, paying the bills, paying the mortgage, whatever it might be. If one of you is not there tomorrow, that's a loss of income. We need to protect against that. We also need to protect against, potentially you that's been left behind wanting some time off and being able to deal with such a traumatic event and being able to replace that income at that moment in time. So ensuring one another in a relationship, or ensuring yourself so that those left behind have got a little nest egg that they can call upon to deal with that traumatic time, replace any lost earnings as a result of you not being there, replace that increased expenditure that you may have to go through. Or even if we're looking at taxes down the line, estate taxes, ensuring and offsetting those right now, and not having to pay the full amount for it later on. So there's things that you need to consider there. And then finally, healthcare. For many of us who are in jurisdictions where there isn't a social system in terms of healthcare, we're obviously paying for medical insurance a lot of the time, whether it be the US or here in the Middle East. A lot of that is sometimes covered by your employer, for example. But don't forget, later on down the line, if you're going to move back to America to retire, you're going to need some sort of healthcare. And if you're going to be stepping into the US at a significantly older age than you are today, and you're going to want to go and get some coverage for your medical, it's going to cost you an arm and a leg potentially, and the premiums that you're going to be looking at that point in your life. So what are you doing today to secure that? What are you doing today to plan for that expense? Can you get a policy today that allows you to be an international client, but allows you to return to the US, allows you to gain access to medical coverage, so that you're not having to start a new plan with any history of having to declare ill health, critical illnesses, things that are really going to bump your premiums up later on in life. Having a single coverage over a longer period of time may serve you much better. So think about that coverage and what you've got to protect your income, protect your loved ones in the future, and ultimately protect your overall wealth against the up and coming costs of these things later down the line. So that's insurance. Not one that's always high on the list of people to talk about, but one that I think is incredibly important. One that's pretty prevalent to today. We're going to talk about debt. There is ultimately what I would call good debt, and there is bad debt. Good debt is something that is long-term and low interest. So if anybody's taken a mortgage out in the last decade, you've probably been able to obtain, up to a 30-year mortgage on a 1 or a 2, 3% mortgage over that period of time in the US. I think that's obviously changed right now. We've seen a sharp increase in the cost of borrowing and interest rates as a result of where the global economies are right now. But that short-term borrowing cost is having a significant impact on short-term lending, and things like credit cards, for example, short-term debt, variable debt that's not tied in for any certain period of time, etc. That's the sort of stuff that is bad debt. That's the sort of stuff that we want to crush right now. Credit cards historically had a very high APR on them already. That would have just been pushed higher recently. So as part of your budgeting, and it goes back to budgeting for a second, as part of your budgeting, we need to work out, maybe we need to make some sacrifices today in order to pay off some short-term debt and be able to crush that right now, so that we're not paying excessive amounts of interest for no reason, right? And being able to look at that and get that down so that we can afford to get that cost done and dusted, get that free cash flow back into the household, and then allocating that free cash flow back to investments and things that can provide us a return for the future and grow our wealth. So really prevalent today. Again, going through that income and expenses once, twice, 3, 4 times a year allows you to manage that and understand what outstanding balances you have on credit cards, and ensure that they're not building up and rolling over month to month, and you're having to pay more interest than you need to. Right, the fun one. Financial goals, goal setting. Goal setting is a huge part of financial planning for me, and investment management for that matter. And a lot of what we do really is based around, you know, time horizon, what's the purpose of the investment, understanding what the objective of that account is and what role it's going to play in the future. And I think, again, this goes back to kind of budgeting, income and expenses, understanding when you're going to need to draw down on cash in order to facilitate whatever cost it may be associated with, gives you a really good idea of how to get there and how to manage it in the first place. I think when it comes to actually getting the right vehicle in place, many of you may have faced the same challenges that you have with banking, offshore providers. Again, that world has shrunk, very few to talk to. Asset managers around the world, whether it be, let's say, those that are based in Switzerland that are gearing up towards dealing with US clients, just continue to raise their minimum ticket level, you know, $1 million plus as a minimum investment, etc. It just makes it very difficult to access the market. I think a lot of the time we would always look to choose the US as the place in which we house an investment for a US connected person or an American living overseas. Really, and these are just some of the reasons, but, you know, for these reasons alone, your access to market in America is well, America has the largest financial market in the world, right? So our access to market is vast. We've got the ability to access lots of different instruments that cover lots of different sectors, regions, and industries, and allow us to be able to put together comprehensive portfolios. The compliance that sits around it is great in terms of its quantity and quality. You've got, you know, you've got regulators at local, federal levels, state levels. You've got the SEC and the overall arching compliance of that. You know, the ability to have well-regulated environment for you to access financial markets is incredibly important, and making sure the protection is there for you as a consumer. The next two go hand in hand, which is reporting and taxes. And this is something that's going to come on to some things that we don't want to invest in. Having the right reporting for your investments is crucial, and you're only often going to find that with a US-based institution. And that's ultimately because of the tax regime that we have in the US, and the one that spans across every American living anywhere in the world. We have that obligation to file taxes every year. But the reporting that comes from your investment accounts is critical to the success of being able to pay your taxes. So with a US account, you're normally, for a brokerage account, going to get something called a 1099 form at the end of the year. That 1099 is going to have all of your income, all of your gains, all of your losses, all of your fees. And that's something that you can either take and do your tax return or give to your accountant in order to pay your taxes efficiently, effectively, and on time, right? Not doing that then starts to create problems, potentially fines, et cetera, et cetera. Not doing it properly, you know, can get messy. So the reporting and the taxes is very much linked. Having a US account allows you to report correctly and pay taxes correctly. Having a US account also potentially allows you to be tax efficient. And I'll talk about that more in a little bit time. But, you know, so this now starts to build safety for me, and having safety in these aspects. The other one really is fees. What you typically find is offshore accounts potentially have fee structures of 1 or 2% more than a US account. And it doesn't always mean that, you know, paying less is more, for example, but fees do have a big impact on your overall portfolio return over a long period of time. And if you're investing for long-term goals like retirement, you know, then you need to be aware of what you pay for, I think is the most important thing. This is, I love this slide because there's so much that can be said from so little. But over the years, I've met so many people who have said, oh, I've engaged with the US asset manager and I've not been very impressed with the returns, or I've only got 6% a year when the market's been doing 10% a year. And I think this is why I favor financial planning rather than just an asset management approach when it comes to looking after money, because money is just much more than trying to grow it to the most it can be. Financial planning is about trying to get you to a point where you can achieve and have options. And, you know, I've met people in the past who have gone to an asset manager, they've done an attitude to risk questionnaire, and that's all they've done. And they've ended up in a conservative portfolio because that was their attitude to risk. And no other conversation has been had around the purpose of the account, the longevity of the account, i.e. the time horizon, what the outcome of the account is going to be. Is it going to be in an account that needs to provide an income, or is it going to be an account that's designated for capital expenditure? And if you don't have that conversation, you don't really complete the risk tolerance questionnaire, because it's those questions that have such an impact. If you're a long-term investor, you really should potentially be gearing yourself towards a more aggressive portfolio. You need to understand what comes with an aggressive portfolio, which is volatility. But if you've got the time horizon on your side, you can potentially stomach that volatility. Your capacity for loss through that period of time is greater because time is on your side. Whereas some people may be really aggressive in their nature, but only have a short time horizon, in which case an aggressive portfolio, because of the volatility, wouldn't be appropriate, and potentially a more conservative one would be. So risk tolerance is critical, and understanding how your portfolio is constructed and invested compared to those factors of purpose and time horizon are crucial. And I can't stress that enough. And we'll go on to linking that into managing investment accounts shortly. What I will say at Skybound is that we always remember it's your money that we're investing, and you really do come first. We want to try and think long term. We want to diversify well. Costs do matter to us. Keeping it simple is going to be the motto of our story through this webinar and through the series of webinars that will follow on, because overcomplicating it does make life more difficult. Staying disciplined is a key factor, and often today I say that one of our biggest roles as a financial planner is a bit like a personal trainer, where, you know, we're a personal trainer for finances. We keep you in good shape, we keep you on track, we keep you disciplined for your goals, and, you know, we tell you, if you're going to do that, it's going to have that effect. If you do this, it's going to have that effect. So, you know, we want to invest for good. We want to invest for good reasons and invest for the future. Once you've managed to work with somebody who's got you the right vehicle, so it may be, in your case, it potentially is a US account because that's the right thing for you. You've gone through that attitude to risk and that risk tolerance questionnaire. You've gone through the purpose and the financial planning and the goal setting around that account. We then start to look at how the portfolio is designed and what it consists of. You know, diversification is key. Things to consider as an American living abroad is things like currency. You know, what's your currency spend in the future going to be? If you're living in Europe and you want to retire in Europe, your currency spend is going to be in euros. So you need to be able to fight the inflation fight of Europe, which may be different to that of America. And therefore, your returns need to be based upon the inflation rate of Europe, not America. Your currency exposure needs to make sure that you're not having to risk currency across US dollar and euro. So how do you manage that? You know, you can invest in underlying companies across Europe. You need some potentially American exposure in order to get the gains out of that marketplace. How do you manage all these things in order to get what's right for you? And that's where we do a lot of work. And there's a lot of asset classes that we can look at. And there's a lot of different sectors that we can look at, regions that we can look at, industries that we can look at in order to help you achieve your goal. Okay, so a couple of things to not do, or certainly stay away from, when you're building an investment strategy within the right vehicle. I've spoken about this briefly, and this is going to come up time and time again. I think it's a lot harder today than it was certainly previous to 2010 to invest in what we would call a PFIC. A PFIC is a passive foreign investment company, or basically any collective investment vehicle outside of America. That could be a mutual fund. Two very popular destinations for mutual funds outside of America are Ireland and Luxembourg. So if you are looking at an investment account, let's give an example. Let's say you are a UBS customer and you live in Europe today, or the Middle East today, and you're talking to UBS about investing. They will be looking at mutual funds that are based in Luxembourg or Ireland, for example. Those investments in the eyes of the US or the eyes of the IRS are classed as PFICs. And I think they're potentially a little bit more difficult to be invested in today because of FATCA and a lot of institutions steering clear of American clients, especially when it comes to investments. That's not to say that some people may use or may be asked to use a different passport if you have multiple passports, etc. You have to declare that US connection, and that should help you steer clear. But it doesn't necessarily mean that you're not, okay? So if you do have an investment vehicle that is based outside of America, often this is going to be met with punitive taxation from the US. And I think the easiest way to get somebody's head around understanding why it would be taxed more aggressively than a local or a US domestic investment is, let's take Vanguard as an example. Vanguard has, if we're using Vanguard in the US, okay, so Vanguard have an office in New York, for example. They've got people living and working in New York. Vanguard, the corporation, is paying corporation tax in America. Vanguard employees are paying income tax and state taxes and social security, etc. And then you, as the investor, you're paying capital gains taxes, right? If you're using Vanguard, also have a fund in Luxembourg, maybe the same fund. It may be a US equity fund. It may be exactly the same thing. But because they've chosen to domicile it out of Luxembourg, the office is in Luxembourg, the people in Luxembourg, they're not paying US tax, they're not paying US estate tax, corporation tax, they're not paying US income tax, they're not paying US social security. So Uncle Sam is missing out on all of that taxation. And therefore, he doesn't let you use the capital gains tax allowance. He then has to use his most aggressive form of taxation, which is income tax. So I'm not saying that's actually the true reason as to why PFICs are taxed at an income tax rate, but I'm using it as the example as to trying to get people to understand why it's going to attract a higher rate of tax. Okay, so it's not a US domiciled asset, it's one that's overseas, and one that the US is going to tax punitively as a result of it. The other thing as well is the IRS actually think that it takes 22 hours, man hours, to file a PFIC on their tax return. Now, I'm pretty sure you don't want to spend 22 hours doing it. I'm pretty sure you don't want to pay an accountant 22 hours to do it. And if it's done wrong, the fines can be up to 50% of the account value. So if you're going through your accounts today, or you're reviewing your accounts and your investments, anything that's an investment account that's not based out of the US, you need to ask yourself, is it a PFIC? Because it's potentially something you don't want to keep. And you need to understand potentially how you get out of it, what's the best way of doing it. There may be penalties applied to it, but I would start to question that, okay? I'll come back to PFICs in a second as well, because there may be a surprise one that you might not be able to think about. Believe it or not, US mutual funds cannot be purchased if you're not a resident of the US anymore. This has been a law that's been around since, I don't know, the late 70s, 80s, or whatever it was. It is actually against the law to be able to buy US mutual funds for non-residents. And that's, again, another reason why so many institutions in the US have started to clamp down on having international clients, because they can't offer potentially a restricted service. They can't stop you buying mutual funds. And there may be implications for those institutions as a result of it. So the other thing as well is that mutual funds, if they're in a taxable account, like a brokerage account or an individual account, they may not be the most tax efficient vehicle for you anymore. Things like ETFs could be much more tax efficient because they're not passing on the underlying transactions of the mutual fund, and therefore allowing you to roll up that growth until you sell the asset in the future. So again, potentially you want to be avoiding US mutual funds if you're an American living abroad. And the third one is look at the fees that you're paying. You know, I've said earlier that offshore investment accounts can often have a higher fee associated with them. A lot of the time that's just driven by market size. You know, markets across Europe or the Middle East, then they don't have the same amount of people. They're not as big as the American market for the purpose of access, and therefore have a higher fee associated with them. The US market, largest in the world, fee compression has hit, all for the benefit of you, the client. But just understand what you're paying for, understand the benefit you're getting for the result, for the fee that you're paying. So things that we do want to look out for, again, like I said, US accounts, real positive, exchange traded assets, whether that be stock, shares, bonds, ETFs, whatever it might be, they're potentially going to have a lot more benefit for you, certainly from a tax point of view. And the other thing is just continue to fund accounts. And this kind of rolls on to my next point, you know, cost averaging or dollar cost averaging, continuing to buy into the market. It's impossible to time the market. Time in the market is the most important thing. And buying into the market on a regular basis will allow you to achieve that. Retirement accounts are always one surefire way that you continue to build wealth and buy into the market regularly, because they're often derived from an employer's income and they're being contributed to by you and the employer month by month. When you leave America and you move abroad or you've moved country recently, it's always well worth revisiting those retirement accounts. You know, if you've got retirement accounts in the US, you've got a 401k with an old employer. Ask the question, why? Why do I have that? What purpose does it have today? What options do I have with it? Do I have any options? Are there things that I can do better with it? Is there more opportunity out there for me? Okay. You need to be asking these questions to make sure that you're continuing to contribute towards the success of your financial future. With 401ks, you do have options. You have the ability to roll them over to IRAs if that's the right thing for you. You know, and we'll go into that in more detail in a separate session, but it's really critical for you to understand the pros and cons of the options that you have. So that's looking at domestic accounts back in the US. Foreign retirement plans, again, you know, you're now in a new country. You may not have access to a 401k because you're working for a foreign company, but you may have, you know, the local version of it. So you have, again, your social security payments that be paying to some sort of maybe government pension for the future. You may have then your employer pension, and that may be mandatory, and you have to contribute to that every month. Again, like I said, a great way to build wealth. But you also may have other options. You may have what we would call additional voluntary contribution pensions. So, you know, pensions that allow you to contribute and get a tax break on your local taxes, right? So here in the Middle East, we don't have too much of that. We don't have much tax to think about, for example, but in other parts of the world, we do. So you may be able to contribute to a voluntary pension, okay, and be able to reduce your income tax for the year. But because it's a voluntary pension, and this is, be careful, it may be classed as a PFIC. It's a voluntary contribution to an investment that's not American. Does that put you in a position where you're then having to pay higher taxes back in the US? Does it put you in a position where you could have, if you don't report it properly, a fine that's worth 50% of that account value? These are the things that you need to understand, and you need to understand both the domestic options that you have in the US and the foreign options that you have with those pensions with where you're now living. It's really important to understand them and review them and get to grips with how they're going to impact your financial future. Like I said, if you don't understand them, the outcome can be drastic. The drag of taxation on account can be life-changing. The drag of fees on an account can be life-changing. Not having those accounts invested properly can be life-changing. You know, if you've left a 401k back in the US and you left it as an incredibly aggressive portfolio, you're relying on it for your income in the future, you've now spent 10, 20 years outside of the US and you've never touched it ever since, Well, this year you'll be really kicking yourself if you need an income from it, because it probably would have seen the most significant hit that it's seen in 15 years. So managing those assets is critical, and making sure that you're on top of them is crucial. This goes back to a little bit what we were talking about earlier, tying in with what I've just said then. 2022 was one of the hardest years we've seen in over a decade in the financial markets. And a lot of my job is like a personal trainer. It's about invoking that discipline, keeping you on track for your future goals, making sure that, we make you aware of what's, the impact of doing this is this in the future, right? And showing you how to get there. And discipline really does come into markets when we see volatile markets in a downward trajectory. And being able to hold the hand of a client, walk you through the steps, make you aware and educate you in order for you to make rational, educated decisions, that's a large part of our job. And that's something that is critical as a financial planner, and why you potentially would want to work with somebody over the medium to long term. We've covered quite a lot today, but we've covered quite a lot at quite a high level. You're always welcome to get in touch with us here at Skybound, and we can provide financial advice for you as an American person. Like I said, we are regulated in the US. This is our disclaimer for today. One thing I must make clear is that we're not tax advisors or tax professionals and can't give tax advice. We ultimately offer services to US connected clients through our Skybound Wealth Management USA entity, which is an SEC regulated entity as a registered investment advisor. Each advisor is then registered as well. So I am personally licensed as a Series 65 investment advisor over in the US. Like I said earlier at the start of the webinar, we continue to do more webinars like this, and we'll continue to go into more information and take a deeper dive into certain topics over the next few weeks. If you've got any questions, please feel free to reach out to me. We've got some coming up in the chat box already today, so that's great to see. Sadly, I am going to run out of time, but if you'd like to connect on a one-to-one, just shoot me a message, and we can take things from there. Let's answer a couple here quickly. So one question coming in, can we help with existing accounts back in the US? Yes, we can. Yeah, so again, if you've lost contact, like I said earlier, if you've lost contact with an advisor, or you're not in touch with what's going on in that account, we can certainly help manage those different accounts. We have terms of business with lots of providers in the US. We may not have terms of business with your provider, but we can certainly potentially look at getting you into an environment that we can help you manage accounts with. So yeah, that's it from us. There's plenty of messages shooting in. We'll come back to you on a one-to-one basis, but really enjoyed having you along with us today. And we look forward to seeing you again in the future.